What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Savanovich. I work at Spoonbill Partners as a trader slash investor. We trade stocks, bonds, derivative products, public equities, private equities, you name it, and we've probably traded it. So, keeping in theme with recent episodes, we are going to discuss things that I'm seeing in the market and geopolitics, macroeconomics. Going to talk a little bit of syndicate again today. It's the middle of summer, and next week is a shortened holiday week because of July 4th, Independence Day. So Friday, the market is actually closed. So it feels like since last week was Juneteenth, and then next week is Independence Day. There's a little bit of a quiet period here. There's not a ton going on at the time of this recording. Micron would have just reported its earnings. Cerberus reported earnings the day prior. But regardless of all of that, we still have a couple of things to discuss. So without further ado, let's jump right on into the show. First things first, let's talk about Cerberus. We're going to talk a little bit about their report. We're going to talk about the price action since the stock IPO'd roughly 1 month ago, a little over 1 month ago. So I've discussed it a couple times on this show before. Cerberus priced its IPO at 185. The stock opened at 350. I think traded as high as 368 on the first day. And since then, it's been a bloodbath. The stock has done nothing but trade down. It's had a couple of up days, but the general trend has been lower. And officially today, the stock was down 20% or something like that after they reported earnings yesterday after the close. Right at the close today, the stock officially broke its deal price. Remember, I said the stock priced at 185 when they were doing the initial public offering of the shares. And at the close today, the stock was 182. So officially, everyone who participated in that IPO is now underwater if they didn't sell their shares yet. So let's go through a couple of the numbers from the quarter. I wrote down a couple of things just so I didn't mess them up. Revenue beat up 92% year over year. Earnings per share loss of 4 cents actually beat consensus estimates. I think consensus was at a 15-cent loss roughly. Full year 2026 revenue guide was raised to 855 to 865 million. So net, the headline numbers weren't awful. So what went wrong here? Why did the stock trade so horrendously terrible today? I think the margin story was a little bit tough for people to swallow. Second quarter gross margins, I wrote them down here, were guided to 36 to 38%, which is a steep drop from the 46.5% core gross margins in the first quarter. Full year operating margins are expected to stay deeply negative, somewhere in the neighborhood of negative 28% to negative 32%. And I think when you take that into consideration and then you understand that the stock is trading at 64 times forward revenue and the company has deeply negative operating margins, and then on top of that, the customer concentration is extremely narrow. Something like 86% of the firm's revenues are from 2 UAE-based companies. And then you look at the backlog, and that is extremely concentrated as well. I want to say over 80% of the backlog is contracted out to OpenAI. And we've discussed at length on this podcast about how I'm a little bit suspicious of all of these commitments OpenAI has to so many different companies, and if they're going to actually deliver on all of them. And I don't remember if we discussed it before the IPO actually happened, but I do remember reading it in the prospectus. 2025's reported profitability was just sort of a bit of accounting magic, if I can say that. It was a one-time non-cash gain in the second quarter of 2025. All the other quarters, they lost money. And then there's one little nugget from the conference call that I think is important to point out. And, people might point to the margin story and say, well, it's in deeply negative territory, and for a stock trading at that multiple, you shouldn't have margins that look that bad. Sure, there's a couple negative things to pick apart here and there, but something that I read that I thought was interesting was that management blamed temporary third-party capacity costs as they scrambled to put together their own proprietary data centers. Now, why do I think that's interesting? I think that's a pretty clear negative, especially given what's going on in the tape right now. And that might be a slightly larger reason why the stock sold off so aggressively. The company is effectively saying their biggest constraint isn't technology, but the limiting factor is building out data center space. That seemed to be a big focus for Cerberus. Now, look at the tape. Look at some of the hyperscalers. Look at how they've been punished. I think as of Tuesday, today's Wednesday at the time of this recording, but I think Tuesday when we had the big sell off Monday or Tuesday. A lot of the hyperscalers officially entered year to date negative territory. And again, they're called hyperscalers because they're spending the most amounts of money on this data center, CapEx, build out, whatever you want to call it. And so, sure, in 2022, 2023, if you announced that you were going to spend $50 billion of your cash on the balance sheet to build out 20 data centers in Virginia or wherever the heck you're building them, you were probably rewarded. Your stock probably ripped on that news because everyone was rewarding those things. But now we're scrutinizing all of these CapEx announcements. When Amazon says they're going to issue debt, and when Google does the secondary offering, when Meta does the secondary offering, and the stocks get punished for it, and then you hear whispers that token prices are going down. I think a big reason why Cerberus traded down today was because of this. And frankly, if the CEO had said, hey, the limiting factor is data centers, so we're just going to pause that and we're going to focus on our chip technology and selling that to whoever does have data centers currently up and running and maybe compete with NVIDIA, AMD, whoever, you might have seen a slightly better stock reaction. Again, I can't speak to every single person who traded Cerberus today and sold the living heck out of that stock. So I can't say that it would have been green on the day if they had said that, but I do think it's interesting that that was mentioned on the conference call. You see what's going on in the environment in AI with regards to CapEx, and I just don't think it's being rewarded like it once was. And I know that's an obvious thing, but maybe people didn't pick up on it in the Cerberus report, sorry. And hence you get the move that you did today, and it officially broke deal price. Now that it broke deal price, a lot of people are losing money on the trade if they entered at the IPO. You might start to see some exaggerated selling. That's not an official call from me or anything like that. It's not advice, nothing. I don't give advice on this show, but I think it's an interesting name to keep an eye on because it could get ugly. Conversely, people might think it's a bargain now and want to buy more stock at 185. And regardless of all of that, to have a move from effectively 350 on the first day down to 182 today in 1 month, that is a really big move to have in that name. Stock almost got chopped in half, basically. So it's just a little bit more of this classic IPO exuberance. And I think it speaks to the wobbly IPO market in general right now and this sort of weird feeling in syndicate. I think, you obviously see SpaceX traded up for the first few days and then came right back in to where it opened. I think that stock was trading at roughly 185 today. And if you remember a couple weeks ago, it opened at 180, priced at 135. So yeah, like I've said a few times on this show, I think it's always good to pay attention to syndicate. It's a good barometer of health in the stock market. And Cerberus is just one of the latest examples of a very, very hot IPO that got a reality check very quickly. And I think the timing, interestingly, coincides with a market that is sort of starting to scrutinize CapEx a little bit more. So moving right along from Cerberus, we're going to talk about the Iran and USA MOU deal, whatever you want to talk about. It's not really a deal. It's an MOU. We'll get into that a little bit later. So first off, what is an MOU? An MOU is a memorandum of understanding. It's not an official treaty or contract. It's effectively a framework, a document that basically says we are going to agree to keep on talking and work through this over a set period of time. Obviously, the timeline, as many of you know, is 60 days. It's a 60-day extension of the ceasefire to negotiate all of the remaining details and the final terms of what everyone's hoping will eventually be an official deal or treaty or something like that. In the MOU, they talk about the reopening of Hormuz with no tolls, no fees, nothing like that. But the catch is that there's no charge or no toll for the 60 days. So whatever happens after that, it might go back to war. It might go back to we're going to charge every international vessel traveling through these waters. Who knows? As of right now, we've only got these few things in place for 60 days. Iran is supposed to demine the strait in the first 30 days, meaning they're going to remove all the explosives and incendiary devices that are under the water that shippers were not really thrilled to travel over because it meant that a lot of very precious cargo might go to waste and blow up and end up at the bottom of the ocean. The USA is going to lift its naval blockade of the strait, and the USA also waived all of its sanctions on Iran, which is effectively going to restore Iran's oil revenue back to pre-war levels almost immediately. So the reason I bring this up, there's obviously There hasn't been, I wouldn't say exuberance in the tape. The tape has been wobbly this week. We closed lower today. We had a rough start to the week. So you're not seeing this continued buying in the tape, which I think was sort of expected because this MOU or deal narrative has been happening for the last month. And we talked about it on a couple other shows before. For the last month, the market has done a pretty crazy run up based on that and a couple of other things. So I don't think anyone really expected the tape to go berserk, ballistic higher based on this. We've seen a little bit of a wobbly stock market, but the price of oil has dipped to its pre war lows. So oil is telling you that everything is hunky dory and all good. But I'm here to mention on this podcast that the MOU is a nonsense document. The nuclear issue in Iran has not been addressed whatsoever, and that was arguably the most major main sticking point for the US. Iran's commitment to not build a nuclear weapon is the same thing that that government has been saying for the last 50 years. It's nothing new. The process for downblending their uranium to 60% has only agreed to be discussed in this 60-day period, so it's not actually happening yet. It's just we're going to discuss it and work out those details later. The ballistic missile program was left completely out of the MOU, and Iran gets paid up front. They, like I said earlier, get their oil revenue restored with the opening of the strait. $100 billion in frozen assets is now unfrozen. And you might have to fact check me on this, but I think there's a $300 billion reconstruction fund that Iran is getting, and the US is just getting promises to keep discussions moving forward. So, if you're looking at Donald Trump's Twitter posts or X posts, whatever you want to call them, Truth Social posts, he's really trying to frame this as a big win for the US. And look, I'll say this: the reopening of the strait, oil prices coming down, those are tangible, hard wins as a result of this MOU. But I think we've sort of placed just a good bandage on a pretty serious wound. It's enough to get you to the hospital to get some surgery and figure yourself out. It's not going to solve the issue that if you don't get medical attention, you're probably going to die if you're out in a field somewhere and nobody's rushing you to a hospital. I just think it's a temporary solution that hasn't addressed any of the major issues that Trump wanted to address. And so Trump can call it a win all that he wants. I don't know that it was a win for the US right now. Do we get to the end of the 60 days and all these things are addressed? Then yes, I could potentially call it a win then. But as of right now, any sort of celebration or fist pumping because we reached an MOU with Iran where not a lot was guaranteed other than the straight reopening is sort of a shaky deal in my eyes. It's not even a deal. Like I said, it's an MOU. Iran still has the leverage to reclose the strait if they want to. Like I said, the no tolls, no charges, no fees to travel the strait only lasts the 60 days. And after that, if that's not resolved, it goes back to the way that it was. And even days after the MOU was signed by both parties, Iran was already threatening to close the strait, and Trump was threatening to invade once again. And so I think that sort of tells you how fragile this whole thing is, shaky, if you want to call it that. And so this whole 60 days thing, it's like I said, it's just buying you time. I think Trump realized the price of oil was going to hurt his citizens. It was going to hurt inflation. It was going to prevent Kevin Warsh from ever cutting rates this week. Not this week, this year. It just had too many negative implications. And so something needed to be done that wasn't warfare, boots on the ground in Iran. So he decided, what's my next best option? I got to buy us a little bit of time. So it looks like we're approaching a peaceful settlement, even though we might not be. None of the genuinely hard-hitting questions, contentious arguments were addressed. Frankly, it's just a de-escalation mechanism, which is completely fine, but we shouldn't be celebrating it as a win. There's still a long road to go. We're nowhere near from being out of the woods on this one quite yet. And to cap this off, I would pay attention to oil markets, specifically XLE, USO, UNG. Sweet crude futures, Brent futures, they're all impacted by this. I would pay attention to those because, like I said at the beginning of this section, they've now traded to pre-war lows, specifically the oil contracts. And given the fragility of this deal, if anything is to go wrong, if Iran is to throw their hands up and say, we don't want to do this MOU anymore, we want to charge ships to cross the strait, like any little thing that sparks some sort of disagreement, you're going to start to see oil tick up right away. It's that sensitive to what's going on. And we've spoken a few times on geopolitical risk premium in oil prices. Effectively, that has been completely removed with oil trading at pre-war lows. And I just don't think, like I said, we're not out of the woods yet. So there should still be a little bit of geopolitical risk premium built into the price of oil because we haven't signed any treaty or hard contract. This is an MOU, and there's still 60 days where lots can happen. And so I'm sort of thinking that this is the floor for oil for at least the next 2 months until some sort of treaty, some sort of resolution is agreed on. But that's just my opinion. I'm going to keep an eye on it. I've got no trades, no stakes in the game, no irons in the fire on that one. But for you listeners who watch the pod and trade markets, I think it's an interesting dynamic to pay attention to because it will eventually impact the rest of the market as well. Now, last thing, we're going to talk about the tape in general, the softness in the tape. And I've spoken many times on this pod about the SOXX and the SMH and this historical run up in semis and specifically memory names. And now they're all getting smashed. What are the reasons for that? Well, you can point to 12 different things as the reason. I honestly just think things got way too extended, way too overbought, and they needed to correct a little bit. But what I think is interesting is you're starting to see a rotation into some of the unloved parts of the market. So many times on this podcast in the past, when I talked about the overboughtness of semis, I never really offered well, what's not overbought? And an interesting dynamic that I'm starting to pick up on is the RSP. If you punch that up, is an ETF that tracks the S&P 500, but tracks them at equal weights, every single constituent at an equal weight. The SPY is the popular one, is the market cap weighted version of the S&P 500. So obviously in the SPY, the Magnificent Seven stocks are going to be the most heavily weighted stocks in that ETF. They're going to be the largest parts of that ETF because they're the largest market cap names in the entire S&P 500. But you look at the RSP, all of the 500 names in the RSP are weighted the exact same. There are equal amounts of each stock in that ETF. And the RSP has been holding in really nicely. There's had a couple green days the last week and a half. And even on the days where there was aggressive sell-offs in the hyperscalers, the RSP was only down a few basis points. And so the RSP is holding in really nicely. And what does that tell me? It means that there's other parts of the market, most other parts of the market are acting completely fine. There are no cracks. There are no worries. I've been paying attention to the staples, the utilities, real estate specifically. And these other parts of the tape are really, really acting fine, really acting well. And it's really the semis, the optical names, the memory names, and the Magnificent Seven hyperscalers. Apple is sort of okay because it's sort of insulated from the AI thing because they don't have the huge CapEx problem that Google, Meta, Amazon, Microsoft has. But I think the market is presenting us with sort of an interesting opportunity here. There's clearly a rotation from growth into value occurring, or maybe it's not really growth into value, but there's a rotation from semi, and I shouldn't even say semi, but data center levered stocks, like I just said, memory, opticals, semiconductor technology, into other areas of the tape that have not seen the aggressive run-ups that former group has seen. So just as a trader and as an investor, I implore you to explore the rest of the S&P 500. There's a lot of high quality names that have lagged the index this year or traded in line because so much money has been poured into so many other speculative things, speculative syndicate, non-profitable names, meme stocks. There's a lot of really high quality stocks out there that people have not paid attention to this year. And I think we're starting to see a little bit of a rotation out of the traditional loved names in the last 2 years into these other parts of the tape. And it might present a sort of interesting investment or trade opportunity. And so I just wanted to point that out because I've been watching the RSP very closely. And I did find it interesting that it outperformed the tape so well the last week and change. And so again, I'm not giving you any investment advice. I'm not telling you to sell all of your tech holdings and go buy staples or go buy utilities or go buy materials, go buy defense, whatever. I'm not telling you what to buy or what to sell. I'm just saying if you are a stock picker, if you are someone who likes to trade the tape or pay attention to these flows are one of the most important things in the tape today because of how popular passive buying and selling has become. Passive meaning an ETF has to go buy a million shares of something to include it in the ETF or to rebalance its portfolio. Like passive flows have become such a powerful force in the tape that when you start to see these things occur, like this outflow from tech and inflow to other parts of the tape, those things don't just occur over one day, they occur over weeks and months sometimes. It takes a lot of time to execute these orders. They're giant orders. They're not orders that the average retail broker is putting on. And so pay attention to that. There might be some interesting opportunities popping up. I'm not going to say what they are because I don't give advice on this podcast, but like I said, I do think it's interesting. And, even if you don't trade and you're just interested in the market, understanding how flows work, passive flows specifically, and how important they are to this tape, I think is good to pay attention to. And to cap off this section, I did compile a list of facts just so you understand. I'm sort of reiterating stuff that I've said in the past podcast episodes, but just so you understand how overbought things got. Samsung and SK Hynix in Korea both dropped as much as 12%. That caused the South Korean Kospi to close down 10%, triggered two circuit breakers in a single day. I think Nvidia was down 4% one day. AMD and Intel were down 6%. Some of these optical names are having horrendous price action. I think I saw COHR down 10 or something percent or over that much. And sorry, the reason I brought up the Samsung and SK Hynix and Korea in general, they are memory peers to Micron and SanDisk, Western Digital, Seagate, whatever. And when they crater overnight because their stock market is open when ours is closed, or most people are, it's not technically closed anymore because it trades 24 hours a day almost, but overnight when people aren't trading the US markets, people wake up and see, oh gosh, what happened in Korea? And it sort of influences the memory stocks, that by proxy influences the semi stocks, that by proxy will influence anything sort of related to the data center hype trade that's been going on for the better part of this year so far. And so Korea in some ways has become an interesting leading indicator of what's going to happen in New York the following day. And then you add on top of all of this that the Fed has gotten marginally more hawkish and we might hike rates this year. There's just a couple of negatives floating around that are causing these flows to occur the way that they are. And so my whole point of saying this is you might see some interesting ideas start to pop up. And so now more than ever is a really good time to really sit up in your seat and pay attention to the tape. In the dead of summer, who would have thought that we would be having something as exciting as this going on? It truly is interesting to watch. And it's nice to also see that there's a little bit of deleveraging happening because it felt like we were really levered up for a long time there, just buying these names at whatever crazy multiples. So it does make me happy. As I know I shouldn't say this because I know people bought stocks at some of these crazy levels and are now sitting on losses, but it does make sense to me what's going on a little bit. And it's nice to see a little bit of rationalization happen in prices. I think it's healthy for the tape, but the big question is how long is this going to last? And given how long the rally lasts, you never know. It could get ugly. So with that, I'm going to finish off the episode. Thank you so much for listening to this podcast. Once again, my name is Alex Ivanovich and I work at Spoonbill Partners. Please make sure to follow on Instagram, YouTube, and TikTok. I post a bunch of short form content on there. This episode will be out on Friday next week. Like I said, shortened holiday week. So if you're in the US, have a great and safe Independence Day on July 4th. And as always, take care. Have a fantastic Friday and an even better weekend. I'll see you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.